Going live in 3, 2, 1. Hello and welcome, folks, to Credit Banking Mastermind number 29. Can you believe it? Man, this is super exciting. We got so much stuff. You know, this is all packed full of jam today. Man, this is the week where, so far we've done so much talking about business credit, and we've talked about credit banking. Today we're talking about business credit and credit banking. Pretty exciting stuff. I'm going to share my screen. Boom.
This really is where it all kind of ends and comes together. We've gone through, 4 weeks now?
Yes, we've been through death and life together. All right, so let me share my screen here with you folks. Come now. Come on, baby. There we go. And then we get you off of the presenter screen to the presentation screen. And there we go. All right, what are we talking about? Same thing we talk about every Tuesday night, credit banking and the search for the lost American dream. I'm so excited. Ray, would you do us the honors and read us through the disclaimer?
Perfect. We are not licensed attorney, accountant, financials, any other licensed individuals. Even if we have the license, we're not acting in that capacity. Therefore, we'll not discuss, provide any.
All right. So, folks, do your own due diligence. Realize that the strategies that we teach here are general information in scope. All right. Do your own due diligence. So let's just dive right on in. In case we have new people listening to us each and every week. It's so exciting. We've got so many new subscribers. For those who don't know, my name is Joseph Smith. This is my business partner, Mr. Ray Fleming. We are the Wise Guys in Ties. And yes, we are wearing ties today. Actually, can you believe it? So for those who want to reach out and get more information about working with us, or you want a free consultation, what do? Well, we help people eliminate debt. We help people build businesses. We help people build business credit. We help people with a lot of different ways to help them be successful and to fulfill their God-given purpose. So we help give you the tools and the resources that you need to thrive and succeed, regardless of what's going on in Washington, D.C., or if the economy's up or down. In fact, we want to help you create an economy that you can control. That's what we're all about here. And today we're talking about credit banking. What is credit banking? Well, just so happens I have put together my own definition here. Credit banking utilizes your budget surplus and revolving lines of credit to transfer highly expensive amortized loan interest into simpler and less expensive repayments. This radically decreases the total number of loan payments, which in turn reduces the total amount of interest paid, resulting in aggressively paying down of the principal loan balance in about 1/3 the time. How cool is that?
That's awesome.
I mean, that's really all we need to cover at that point. I mean, guys, that's credit banking.
Who doesn't want to get rid of their debt?
Yeah, exactly. I mean, what do you need to get started? I mean, how can you do the credit banking play it along at home game? Well, you need to collect your 3 pieces, your 3 ingredients. Number 1, you need debt. No problem there, right? Number 2, you're going to need positive monthly cash flow. All right. Now we talk about that each and every time we go over budgeting, which will be next week, I believe. We'll be talking about budgeting. But look, ways to increase your income or decrease your expenses or both helps us produce positive monthly cash flow. It's the fuel that drives the credit banking strategy. And then third, you need a line of credit. This was designed and works around a line of credit. You've got personal lines of credit. There's home equity lines of credit, secured lines of credit. Even credit cards can work as long as you are very careful. And we're actually going to talk about some of the dangers of working with credit cards, today. That's kind of what is all behind the strategy that we're talking about. But that's what credit banking is. So what's the lost American dream? Well, what is the lost American dream to you? I mean, it really is different for each and every person. I mean, my American dream might be slightly different than your American dream. As long as there's chocolate chip cookies somewhere, I'm going to be okay. What is the lost American dream? Well, I would say throughout the history of America, it has always been freedom. We've always been searching for freedom, financial freedom. Think about like Indiana Jones on his quest to find a rare artifact. That's what it's like for us. We're searching for something that we lost, that we don't have anymore. We don't have our financial freedom because all we have are bills. We live in never ending 30-day cycles of income coming in, expenses have to be paid, and we always hope that there's going to be enough money left over to have food in the cupboards and power to run the washer and dryer, right? I mean, and then we just, it's like Groundhog's Day, except it's Groundhog's Month, right? You just, every month it's the same thing. We're just stuck in this 30-day cycle of making payments. What we want to do is we want to break free. We want to be able to breathe the fresh air of, I no longer have debt and I can control my income, as opposed to my check is already spent before I even got paid. That's the worst feeling.
Running out of money before you run out of month.
Absolutely. So what keeps us from our financial freedom?
Out of control debt.
Absolutely.
Too many bills.
Absolutely. Out of control debt. Think about the natives chasing after Indiana Jones in that movie, because a lot of the themes that we talk about here in this PowerPoint are based off of that wonderful movie from Paramount starring Harrison Ford. And but out of control debt, right? And sometimes it's not even our fault. If you think about it, an emergency came up and we had to pay for something, and then you can't ever quite get ahead because now you can't afford the payment for the card that you used, and then you like float a bill to pay another bill, and it just gets out of control. Before you know it, they're coming to repossess the car, foreclose on the house. You're looking at filing for bankruptcy. Crazy, crazy, crazy. Well, folks, we need to find that lost American dream. And that's why you need a map. I mean, and that's really what we've been working on the last 3 weeks, is all the different pieces of that map. In fact, 3 weeks ago, we talked about budget. And then 2 weeks ago, we talked about lines of credit. And last week, we actually talked about the credit banking strategy. And then we put it all together and show you how this works, because the budget helps us get the cash flow, which is the fuel that we need. Lines versus loans, we have to choose which vehicle we want to put our fuel or our cash flow into. And then the credit banking strategy is the GPS. So when you start on a journey to get to where you're going, right, you need a vehicle, you need gas, but then you need to know the route to take. And then if the income or the expenses change, or you've got to take a detour for some reason, what does the GPS do? Recalculating.
Right. Yeah, exactly.
And so that's what the credit banking strategy last week that we showed you, how you implement it, but then also how you have to be careful to take steps to constantly recalculate and see where you're at. So moving right along, come on, there we go. But today is this wonderful time where we talk about business credit with credit banking. Now, a lot of people don't really know what business credit is because they're focused so much on this credit banking strategy, which is pretty awesome.
It is.
Credit banking is how we eliminate our debt fast. Business credit is how we get access to lines of credit. Business credit is built, and we're going to talk a lot about this, but it's built off of your EIN, your employer identification number. That's your tax ID for your business. Whereas with credit, in your own personal credit, your lines of credit, that's all on your social security number. So this is the exciting part where we get to blend these two amazing strategies. Are you ready?
I'm ready.
All right, buckle up. Make sure you're strapped in, because this is good stuff. Okay, so here's what we're talking about. You got my friend Max. Max, why is he called Max? Because he's been maxed out for 2 years. He owns a home, right? He's got some equity in his home. That's great. Max is we've been dealing with a budget. Over the last 3 weeks, we've been talking through the average 2-income American family budget. And we'll say Max is your average 2-income American guy. And so, unless it's Maxine, right? It could be Max or Maxine, but we'll say it's Max. And so he's got $5,000 of net monthly income coming in. And we went through looking at where he was inefficient in his budget, and we were able to free up $2,000 of cash flow because he was living paycheck to paycheck, $5,000 in and $5,000 out. But once we freed up some cash flow, he now has $2,000 of cash flow to work with. So his actual budget is $5,000 of income, net income, $3,000 of total monthly expenses, leaving his budget surplus to be $2,000. Now, he has, of course, all the debt we talked about before. He has the home mortgage still left to pay, 2 auto loans left to pay. He's got his lines of credit, $12,000 balance that he's carrying at 21% interest. Now, Max, just so you know, he's really been watching this credit banking strategy. He's faithfully, each and every week, he's looking at it. And he's like, yes, this is exactly what I need. I want to do this. Because look, he's maxed out, and it's been this way for so long. Do you know what I'm talking about? Or do you know somebody who's living life this way right now, who is maxed out? Like, they've been maxed out for a long time, where their credit card balances are all filled up. And what happens when somebody's maxed out like that? Can you get access to credit, new lines of credit? I mean, what's that like, Ray?
Not easily. No. When you're in that situation, from a lender's perspective, you're in financial danger. You're high risk. Mm-hmm. So no, I don't want to give you any more money. That's why utilization is such a big factor.
Well, are you saying it's because my credit score is down, my debt to income ratio is high, and my utilization's high?
Absolutely.
You don't want to give me any money?
Nope.
Well, you see, this is pretty hard then, because if Max is going to try to do this strategy, he's got to be very careful, because there's a little thing that people don't understand about credit cards. See, this strategy, the credit banking strategy, was designed, the history, where it comes from? Comes from down under, mate.
Oh, yes.
Australia.
Under. Yes.
And this is a wonderful strategy that they use to purchase homes. They purchase homes with lines of credit, as opposed to using mortgages like we use here in the States.
Turn a bad situation into a good one. So have a dingo eat your debt.
Yeah. Yeah. Thanks for the Seinfeld reference there. So here's what happens with Max is, if you had a line of credit, or when you have a line of credit, it's a little more stable than your average credit card. And what I mean by that is, credit cards are very shifty little suckers. They really are. They're slippery. They can change their terms on you, week to week. You get an email saying, hey, we just changed the terms, and you got to look. And what does that mean? Your interest rate can go up. They can lower your credit limit. These things can happen. And so a lot of times we'd like to think that our credit card is actually fairly stable. If you have a $5,000 limit, you think you always have this $5,000 limit. Nope. But at any week, they could turn and change. Actually, we've lowered your limit to something else. Or you think you have a 21% interest rate, and then all of a sudden you find out, no, you have a 28% interest rate now. Like, wait a minute. And you signed a piece of paper when you got your card saying, yeah, you can change the terms on me anytime.
Privacy policy, terms of use, all that stuff. You send it to you in the mail, and you're like, what is this stuff?
And so they can change all of it on the dime on you. And so, and I'm not saying they can't change terms on you with your lines of credit that are out there, but typically those tend to be a little more stable, because you lock in maybe like 10 years or a certain years. And a lot of times there's a security component of either money or collateral that's used to lock down those terms, which makes it stable.
Right.
But a credit card is unsecured, so wow, so it's a bit volatile. And so here's what I mean. Let's take a look at what happens to Max. Max is thinking to himself, you know what, Joseph? I watched your video on credit banking. I'm going to do it. I'm going to take my $5,000. I'm going to follow step number 1. I'm going to put it all onto my line of credit. In fact, I have a $5,000 credit card with a $4,000 balance because I'm maxed out. I'm just going to go ahead and put my income right on there and zero that sucker out. But then look what immediately happens. Immediately, the bank notifies you within a few days of paying that balance down that they lowered your limit. Now, why would they lower Max's limit?
Because they're you have now triggered something into the system that says that you are really, it's that risk factor. It really is that you're high risk.
Well, so because for 2 years I stayed at over 80% utilization.
Yep.
And then when they did a soft pull on my credit, they saw my debt to income ratio was really high. My credit score was low. So
we're seeing this now more than ever. I was talking to this lady 2 weeks ago who wanted to eliminate her debt really quickly because of the situation of the economy. And so they've taken their savings account to wipe out their credit card debt. They had a $10,000 credit line, dropped $9,000 on it. And within 2 days, they dropped the limit to only 1,000.
And you know why? It's because you've really shown the bank that you don't know how to utilize their product.
Right.
Because the bank has to outlay all of this money. They have to make sure that there's money set aside for that. And when you tie it all up and you're just making the minimum payments, maybe you missed the payment or skipped a payment or something like that. Well, this is a liability now for them because they got all this money hanging out there that if they gave it to somebody else who knew what they were doing and using it the right way, they'd be making more money. As it is, they just have, they're just making the monthly APR off of that, if the money's even being paid, right? So this is actually what they want to see is you using the credit responsibly. And so what they drop your limit and they say, look, you're going to have to prove to us that you know how to use this before we give you any more of our money. But now let's look at this from Max's perspective for a minute. Max was looking at this credit banking strategy and he was all excited to pay this card down and have his available credit and utilize the pay down strategy. But from Max's perspective, it looks like he just lost all his money.
Mm-hmm.
I mean, technically, he didn't lose his money because he owed that debt anyway. However, he would not have sunk all of his monthly income into that debt if he knew that he wasn't going to get anything back.
He lost the leverage. Yep.
Right, because that's the power of the credit banking system is when you can convert cash into available credit. But that means when you convert cash into available credit, that means you're playing by the bank's rules. You're keeping your utilization under 50%. You're utilizing the card every single month and you're paying it down more each month than what you put on the card. And so, I mean, you have to follow. I mean, there's more rules than that, but those are the big ones that you have to follow. You got to keep your debt to income ratio low, which doesn't affect credit approvals. But what that does is your credit is constantly by your creditors. There's a soft pull that the computer underwriting system is doing. And so if your debt to income ratio is too high, which doesn't exactly fit with your credit, but what it does do is typically, if you have a lot of loans that are out there, that is going to over leverage your credit and your credit score will fall because of being over leveraged. So there's an indirect correlation between debt to income ratio and your credit score, not a direct one. But these are the type of things where Max is trying to get out of this situation. He wanted to use the credit banking strategy to break free. And now he's in worse than he was before because now he only has he had $5,000. He paid off that $4,000 balance, but now he's got $3,000 worth of expenses and only $1,000 on that credit card to use. So, I mean, he has 2 other credit cards, each with $1,000 left on them. So he still technically can move forward, but now he's going to be even more maxed out than he was before. So what is the solution? It's like credit banking doesn't work. It seems like when you really need money the most, nobody wants to give it to you. Have you ever experienced that?
Oh, absolutely, I have.
So Max is stuck. What's he going to do? Here's where we enter into the realm of business credit. Here's what we want Max to do. We want Max to start a business. And now you're thinking to yourself, wait a minute. If Max is maxed out, he doesn't have any money. His credit score is low. Debt to income ratio is high. He's got so many personal finance issues. How is starting a business a good idea for Max? Can you think of any reason why starting a business would be
it's
a good
the number
idea?
one wealth creating strategy.
That's
the one
true.
thing that the wealthy folks in throughout history have understood is business ownership and real estate, combining your residence with your business, investing into real estate, and funneling your funds through business is very, very powerful strategy. We talk about this a lot.
Well, here's I'm going to give you a test, Ray. And the answer is already on the board. It's start a business, but I'm going to ask you the questions. All right. If you're paying too much in taxes, what should you do?
Start a business?
Yes. All right, let's go to question number 2. If you have overwhelming debt and you need to get write-offs to eliminate that debt, what should you do?
Start a business.
Yes, that's right. Now, what if you're looking to increase income and create multiple streams of income and expand your lines of credit and your business opportunities? What should you do?
Start a business.
Absolutely. What if you're looking to build and grow your retirement? What should you do?
Start a business.
Yes, absolutely. Starting a business is the solution to everything in life's problem. I mean, if you are single and you need to get married, what should you do?
Start a business.
Exactly, because you want to be more of a catch, right?
But then, I mean, so Joseph, we got some folks out there like, whoa, I can't start a business. What do we say to that?
Well, sure you can. This country was founded on people who started businesses.
That's right.
I mean, the Mayflower Compact, the Pilgrims came over. It was a business.
I know, because a lot of folks are like, well, what kind of business could I start?
Well, I mean, they were farmers and other people became like tobacco farmers and stuff like that. But what would you do today? Well, you should at the very least, be in the business of providing financial freedom and security to yourself and your posterity. That's kind of complicated to say that, but what I'm saying is by creating a business and eliminating debt and building for retirement, a business is going to be the start of your financial freedom. If right now, folks, you are trapped in a spider's web, right? In the movie Indiana Jones, there's this big spider web and there's all these spiders, right? Well, that's what debt is like. I mean, you cut free from one thing, and then now your leg is stuck, and you cut the leg free, and now your arm is stuck. See, when you get into debt and you got these bills, it never ends. You refinance a loan, and it's like you're all tied up in the web all over again.
Yep.
And so what happens is that web represents the current financial system as it is. Banks, corporations, the government have all designed this web to put you right where they want you so that you're a good little worker doing everything you're supposed to do, paying your taxes, buying all the products you're supposed to, but putting it into loans, right, with the bank, making interest off of you. That's the system. That's the web that you're trapped in. If you're going to break free of this and create your own economy where you are independent from the folks in Washington and what the folks at the banks have planned for you, the knife or the sword that's going to cut you free is going to be a business. You've got to start a business. Now, there's a lot of strategies that you have to employ with that business, but the business is absolutely integral because the financial system within this country does not reward the individual. It actually works against the individual. As you probably feel, if any of you are stuck up to your neck or even higher in debt, you're experiencing the fact that the system is against the individual. Now, the system was designed to work for the business. The entire American financial system works in favor of the business. I mean, why are there 450 write-offs for businesses in the tax code? And there's only 15 for an individual. I mean, does that seem a little unbalanced?
I mean, we just got to say what it is. This, like you said earlier, this country was founded on business, capitalism, free market, and the government gives you huge incentives to go out there and build a business.
Absolutely.
It is just crazy how many incentives.
So when you're like, well, what business should I start? Well, what did God put you on this earth to do? What are you passionate about? Build a business around that. Do you like hunting? Build a business around that. Do you like traveling?
Yep.
Do you like making models or doing some kind of craft? Whatever it is that you enjoy to do, there's some way to turn it into a business.
Yeah, I was talking to the guy this morning, a really awesome guy, and he's like, "Well, I don't really have anything that I'm passionate about." And I was like, "Okay, I have no idea what kind of business I would start." And so we're digging and digging and digging. And it turns out he used to be really into martial arts. And so he had like really done a lot of training in martial arts. And I said, "Well, ever thought about starting an own studio?" And he's like, "Well, yeah, maybe, yeah. But then nowadays, if they shut down the studio, what else could you do?"
Create a YouTube video series.
There you go, online video training. And I said, "Hey, what about you have some teachers that you've learned from? Why you have this technical skill, you're young, you're savvy. Why don't you partner up with somebody who is up in the years and doesn't have the tech savvy part, and you guys put a video program together on how to
Absolutely.
advance in that?" Boom, there's your business.
Well, I mean, what do people buy? I mean, think about, what do people buy? What do people part money with? Do people buy clothes? Do people buy food? I mean, there's businesses centered around anything that you spend money on. Other people will build a better mousetrap. If you're an inventor, find a new way to do something. I mean, there's literally there's unlimited possibilities. And that's what is great about America, because the next Steve Jobs, right, is just who started a business in a garage that became multi-million-dollar. Jeff Bezos, the next Jeff Bezos is out there, right? And you just have a great idea and you market it. What if your business is a new phone app because you have identified a need, and if you got some computer skills, you could put something together, slap it together, and somebody would pay $3, $4, $5 for it. You get 1 million people spending $5 on your app. That's a good business model right there, right?
Absolutely.
I mean, there's so many different possibilities.
You just got to keep going. You mentioned Jeff Bezos. Amazon was started in 1994.
Right.
Well, I think it wasn't even profitable for the first 20 years or something.
His money that he invested in Google when it was a startup.
Right.
He was one of the first investors. So when that grew, that was his seed money to start Amazon. So yeah, I mean, obviously as an entrepreneur myself, I've studied the history of a lot of entrepreneurs, and you should too, because see, if you don't know what to do, what really you're telling me is that you're too scared to try. If you say you're not passionate about something, I say you're a liar, right? Because if you're not passionate about something, then you're just sitting around waiting to die. I mean, that's not life. That's not living. So you were put here to do something. There's something you were meant to do, and it's probably not sitting around in an office or a cubicle waiting for, the end of the day to come. I mean, your business is going to be an extension of who you are. That's the best business to have, something that fulfills you. If you enjoy, I mean, you could turn, I've seen people turn playing video games into a business.
Absolutely. Because think of this, the easiest way to figure out what you should start, if you can't figure it out, if money wasn't the object, somehow you inherited a lot of money, somehow, what would you spend your time doing? What would you find pleasure in doing? Turn it into a business.
Absolutely.
There you go.
One of the things I've learned from when we started our businesses is how many other side businesses that they spawn. Because, I mean, we get into so many, I mean, you and I started out real estate investing, and we have 6 businesses later. Today we were designing t-shirts. Yeah. I mean, who would have thought that you would be doing that? I mean, there's so many different things, but maybe you want to write a book. I mean, there's so many different things. What if you're good at baking or cooking, right? So folks, we labor the point because so many people tell us, well, I don't know what to do for a business. So if you want to get in a consultation with us, right? We'll just tell you what to do. No, I'm kidding. No, but we'll talk to you. We'll try to help guide you down the path and figure out what fits your personality, what fits your likes and your interests. But start a business. That's what Max needs to do here. But the challenge with starting a business is that 90% of all business startups fail within their first 5 years or less. So that's not encouraging news. 90% of all businesses are going to fail. Well, why do they fail? They fail for 3 reasons, and they're listed there right above the business picture there. They fail because they lack cash flow, right? I mean, business is no good if it's not bringing in any revenue. And then second, they don't have access to credit or liquidity. There's nothing there to help them grow or to invest, to buy more inventory or equipment or machinery, right? A business needs to purchase raw materials if it's making a product, a widget, right? But if you don't have any credit, you can't do that. And then collateral. Every business, as it builds up its product line, if you are retail, clothing line or whatever it is, or you have actual business and office, something of that nature, or maybe your collateral is virtual, right? You have a lot of copyrights, patents, intellectual properties, but all of these things can be collateralized. So a business has to have something to collateralize. So if you had a great idea, but you didn't have cash flow or credit and couldn't bring it to fruition, and you never created your product or you never got the system in place, then you have no collateral. So if a business has cash flow, credit, and collateral, those three components working really well for it, then the business is likely to succeed. But you take away any one of those things. You could have two and be missing one and fail. You need all three of those components to be a successful business.
There you go.
So Max, who's maxed out and having personal finance issues now, you're saying he has to stress out about starting a business and getting cash flow, credit, and collateral now for his business? Well, yes, but if you work with the professionals, it's not as hard as you may think, because building business credit on a business takes only 6 to 12 months. I mean, we're talking about to get an excellent business credit rating and to get $50,000 in trade lines, store lines, fuel lines, and unsecured lines of credit for your business. $50,000 in as little as 6 to 12 months. Now, on Max, he leveraged his social security number. So all of his credit is tied to a social security number. And if you don't know, if Max's credit, let's say his credit's at 450, 500, somewhere around there, how long would it take him to get to like an 800, 850?
Oh, it'd take forever.
Now you start a business and it's got no credit score at the start, but how long would it take to get the business to where it would have like the equivalent of an 800 or an 850 credit score?
6 to 12 months.
6 to 12 months. So as you can see, a very short period of time, Max can have a business up and running and have it have access to lines of credit. So he doesn't have access right now to lines of credit, but his business can get access within 6 to 12 months. So so he starts his business. All right. I mean, what does it cost to start a business? Every place is different. Some places it's a little expensive to start a business, but that's where the tax write-offs come in.
Yep.
Right. So tax write-off, any money you invest into your business, you get back in your tax returns. Right. So here's what's going to happen. Here's how we start creating the synergy. So the next step is Max is going to take out of the $50,000 in lines of credit, let's say $25,000 of that. So about half of that is in the form of, say, a corporate credit card, an unsecured like Visa or a MasterCard. And so what Max is going to do is he has two options really to do this, but your business can actually lend to you on the personal side. I mean, people do this all the time. You pull money out of the one pocket, put it over into the other pocket, right? That's called informal lending, and that's very bad, right? Because you went through all the trouble to set up your business, but if your business lends you money without any documentation, then the IRS, if they audit Max, they're going to look at that as added income, and they're going to tax him on that. Could be at 25%.
Many times you refer to that as like commingling funds.
Yes. So you don't want to informally lend, so you have to create a formal loan. Well, a formal loan is it's so the business keeps its own books, right? We're talking like QuickBooks, like its own ledger, right? And when it lends money out, it goes into a different category. Mm-hmm. And then when you lend money out and it's a formal loan, you have things like the loan amount, and you have so that's your principal, and then you have an interest rate that you're charging, and then you have a term, a set time that the money's out for, and then you have an interest rate. I mean, I already said that, but then you have a monthly payment, And then depending on how much money is lent, there's a security instrument such as collateral that holds the loan in place. Very similar to getting a loan with a bank of some kind. So if you do a formal lending, there's going to be documentation. It's going to be filed. There's going to be security instruments in place. That's a formal loan. And when a business does a loan like that to the personal side, everything's good. There's no problems as long as there's proper documentation all along the way. So as I say this, if Max is starting a business, it's probably a good idea that he doesn't do this all by himself, because he might need some help from an accountant or a bookkeeper or a CPA right off the bat, because this strategy could be a little complex for somebody who's never started a business before.
That's right.
So Max is going to take $25,000 in his corporate credit cards, and he can do one of two things. He could give that as $25,000 in cash. There are different companies that are called third-party processors, where Max could pull the money out for a small interest fee, even as low as 1%, right? And then pay that to, so the business could pay that, and it could be a loan. Now, if you do it as a loan, the accounting on it is much simpler.
Right.
But we are talking here about the option of what if you gave those credit cards or that line of credit to Max as a line of credit that Max could use. So here's how that would work. So you get these corporate credit cards, but they're in the business's name.
Mm-hmm.
So then you would then get an additional account, right? A user account.
Yes.
And Max might get that in his name, but Max's name might already be on the card. So maybe he gets it in his wife's name.
Mm-hmm.
So an authorized user account. What this does is now on the corporate credit cards, they're going to see if Max uses a corporate credit card, his corporate credit card, that's for business purchases. The user account will now show a different set of purchases. So from accounting perspective, the accountant can see, okay, these are business expenses, and here I already have itemized out for me on the nice little ledger all of the personal expenses, because we don't want to what?
Commingle.
We don't want to commingle, right? But we're using the same account, but so it kind of looks like it's going to be commingling. Not if we have proper documentation and we know what we're keeping track of everything. So we're trying to document everything as we go. So now so Max is going to use the user account, and by giving that to himself, I call that getting. What's he going to do? Well, we need a collateral component. Max has got a house. He's got some equity. Max had equity to begin with. Why didn't he just get a HELOC at the beginning? Why go through all of this? Why didn't he just go for a straight home equity line of credit right off the bat?
Well, he didn't simply qualify for one.
But he's got equity. I mean, how many people have told you how proud they are of all the equity they have in their house?
Many times folks don't have enough equity. A lot of banks right now have really pulled back, and they're looking at lending. They're wanting to see more than the loan to value is 85%. That means you got to have more than what is that? 15% equity. Anything on top of that, then they're lending on. But also your DTI comes into a factor.
Oh, absolutely. Yeah.
And so a lot of times your credit score isn't good enough to even get you in a door, and then you can't even get approved for it.
So he could have, let's say you own the house free and clear. If this was the state of his credit, though, he couldn't. So the way you access your equity is you either get a loan or a line of credit against the equity. Right?
Yes.
You pledge the equity in the property as your collateral, or you sell the house. Those are the only two ways to access the equity.
Right.
But because Max's credit is so shot and his debt to income ratio is so high, he's not even a candidate. So it doesn't matter how much equity he has in his house. There's no traditional lender that will give him the line of credit that he needs. So what we're doing here is we're taking this business, we're taking these corporate credit cards, and we are in effect extending a business home equity line of credit. So it's a home equity line of credit from the business, because the business is going to create a private mortgage note, right? And we're going to put that And so if you want to use a title company, and especially in this sense, if you are going to um, put a lien against the property, I mean, Max already has a first mortgage in place. So this is going to be a second mortgage in second position. So a second lien position. So when we start looking at a second lien position, this is like a second mortgage, a home equity line of credit. You got to charge appropriate terms. That's another thing a lot of people don't think about in terms of formal lending. Sweetheart deals don't don't pass the smell test for the IRS. Oh, I'm going to give myself 0% interest, unlimited term. Like, no, no. So it has to be something that's reasonable. And given Max's debt to income ratio and his credit score utilization and all that, and a second position home equity line of credit, it is not unreasonable to get a second position private mortgage note for 2 years at 30% APR. That is that, I mean, given his credit worthiness situation, that's, I think, reasonable. And the IRS, I don't think, would look at that and say, no, that's a sweetheart deal.
No, I mean, I wouldn't if I were the IRS. It makes sense.
Right. Okay. So here we are. We're creating this private mortgage note. If it's a simple loan, not only will the title company file the appropriate lien against the property with the county so that it's registered, it's on file, because we're creating third-party notes, but the title company, if you made this a loan, will service the debt. They'll take all the payments, which is wonderful. It's another way that helps accounting. I mean, anytime the accountant can have somebody do all the paperwork, that's great. So the title company comes into play. So you create a private mortgage note. They service the note, and so at a 30% APR, you would get $625 a month as an interest-only payment if you set it up that way. Keep in mind that these corporate credit cards that you extended, they come when you set up your business. You're getting 0% interest on these corporate credit cards, anywhere from 6 months all the way up to as much as 24 months. It depends on which cards you choose in the process. But so let's say we picked all these 24 months of 0% interest. So this means that the business is extending these lines of credit, and they're going to get paid 30% for interest on this card. So that's going to be the income to the company.
Right.
So if you're keeping track of this, all my accountants out there, right? You see how it's getting a little bit convoluted? You're like, wait a minute, I got to keep track of what's going on in the business. I got to keep track of what's going on the personal side. Yeah, this is complicated. And if it's not done right, it could look like commingling funds. It could look like money laundering, right? That could raise the flag of, the IRS, and they're like, well, we're going to audit this, right? So you don't want to just sort of wing it. You have to do it the right way, provide full documentation of everything that you're doing all along the way, or this strategy could hurt you. And I don't want that to happen to anybody. So that's why we're taking the time to belabor the point. Okay. So with that said, if we set up this private mortgage note through the title company, and we're going to do this as a line of credit, then Max has got this card he's going to use. But if he creates it as a loan, that is, he's going to pay all the money onto the loan. If he's going to use it as a line of credit, well, the title company isn't going to service a line of credit because they're not set up to do that. So all the money is going to go directly to the business. But either way, instead of putting the $500 on his personal credit card, it's either going to go to the title company or it's going to go straight to the business, depending on whether or not you do a loan or you do the line of credit. If you do the loan, you pay the $625 a month as the interest-only payment. But I mean, you're putting $5,000 into that note, which means that $4,325 is going straight to the business as total revenue.
Right.
Now, that's not total income. Revenue and income are different. This is just how much money's coming in. The bulk of that has to go to servicing the business's credit card debt, because all of this $25,000 is debt that the company has to pay back to its creditors. Only the $625 is of that $4,325 is actual income. So so as you look at that, cash flow, we've already established cash flow. So we have income of $625 a month, but we have a total revenue coming in of you add the 625 and the 4,325, and the difference there is whatever the title company took out for its processing fee. So it's like $50, but that's total revenue. So there are a lot of revenue-based lenders, or there's a lot of um, people that lend based off of credit or collateral, but they look at your cash, your revenue component. So they don't necessarily, some of them want to see income. So like if you're going for an SBA loan or something like that, they want to see your income, your tax returns, your P&Ls. They want all of that. But if you're going with a secondary lender in a different type of a term loan, well, they just want to see that there's revenue coming in.
Right.
Right. So you have plenty of revenue. I mean, that's going to look great, right? Just show your bank statements to prove revenue. And then, but I mean, income is only 625. So again, we would be looking for in the future, if we're trying to find additional lending or funding options for the business, we would look at the folks that looked at revenue as so bank statements as the only prerequisite, not tax returns or P&Ls, because tax returns or P&Ls would show a much smaller amount of income. So let's take a look at that. I'm going to actually turn off our camera for a moment, because up in the upper right hand corner of your screen, what you're seeing now is so we already have one star next to cash flow. So we got revenue coming in, but now what we're looking at is what is happening with this $25,000. Did it go out? If it went out as a loan, then the slope that you're looking at would not be jagged. It would just be a straight line down, because you'd be making your payments and then the balance would just go straight down, right? Each payment. Now, if you're using it as a line of credit, then the credit banking strategy would come into play. You put your income in, then your monthly expenses, your income and your monthly expenses. Max would be using the corporate credit card this way, and the Max would then be paying the business, and the business would be applying all of the payments there. So from one perspective, all this is doing for Max is eliminating debt. This isn't growing Max's personal credit. Right. But this is growing the business's personal credit.
Woohoo.
All right. And so what would Max be using that for? So $25,000. So well, if you go back to the budget we were looking at, he has $12,000 in credit card debt, and then he would take probably the other $13,000 and he would put it onto the auto loans. Now he would be able to max out the corporate credit card, because utilization on corporate credit cards is not an issue. So usually when we do a credit banking strategy, we have to always leave 50% available for in case of emergencies, and also because we don't want to violate utilization issues. But here, because we're being aggressive with what we're trying to do, Max can use the $12,000 for the to pay off all of his credit card balances, and then he can use the $13,000 to pay off his auto loans. Well, he's got $26,000 in auto loans that he's into. But here's what happens: his initial cash flow is going to be around $1,325. In 10 months, both the auto loans are going to be paid off, increasing his cash flow by another $600. So now his cash flow is going to be $1,925 a month. So the initial $25,000 is paid off in a total of 16 months. Right? 16 months pays off that jagged line that you see going down the screen where our picture used to be. That's paid off in 16 months. But remember, this line has been extended for 24 months. So what can Max do? Well, with the remaining 8 months that he has on the 2-year interest-only loan, he can put an additional $15,000 towards the principal balance of his home loan. The $15,000 will be paid off in 8 months. So in 2 years, Max has eliminated his credit card debt, his auto debts are gone, and he's reduced his mortgage by $15,000. All in all, he's eliminated $40,000 in total debt. And what does that mean? Well, look what happens over that period of time. Using these corporate lines of credit to accomplish that, these corporate lines of credit can grow. It initially started with $25,000, But as you use this every single month using the credit banking strategy, it can grow up to $150,000. Started with 25, but every 6 months being able to get a credit limit increase, it could grow all the way up to $150,000 in 24 months.
That's amazing.
Absolutely. Let's go ahead and have you see our beautiful faces again, if I can get you there. All right. So, folks, so now we're cooking with peanut oil. So look at that. So the business now has not only grown, it has cash flow, but now it has credit. It started with 25, and over 2 years, it could have up to $150,000 more in lines of credit. So now the business, it's got 2 of its 3 stars. It's got cash revenue coming in. It's got credit coming in. I mean, this revenue that's coming in. These are bank records, and I mean, and it'll have tax statements. It'll have its P&Ls. But this is strong for a business to right out of the gate already be making money. You know how many businesses start and they've been in business for a year or two and they don't even have $1 of income?
That's right.
I mean, this business, so because it's actually making income, it means that everything that Max spent on the startup of this business, he gets back in his tax return. So that'll be nice to get the money back that he spent on the business, right? Because your business has to make money for you to get anything back, right?
That's very true.
Right. Okay. So now, what about that last part here? Well, remember that private mortgage note? Actually, the first star we should have put on collateral, because immediately once the business has a lien position on the property, it actually has collateral. And so the business owns 25% equity in Max's house. So right off the bat, if you look at this, over 24 months, the business has developed cash flow, credit, and collateral, the 3 things a business needs to succeed. And that's great. So the business is doing great, but what happened to Max? Well, we talked about $40,000 of his debt was eliminated. So here's what happens to Max. His utilization goes down because remember, he zeroed out those credit cards.
Yes.
But because Max didn't just sit on his laurels, he made sure he used his credit cards, even though those $1,000 limits, he used them every month, right? And so he built his credit. So the same time, so he wiped those out in the first month, but then he kept using his personal credit cards to grow those lines of credit back to where they were, if not even more. Right. And then his debt, he eliminated he eliminated all of that credit debt, but he eliminated his auto loans debt, and his total debt on his house came down by 15,000. So the debt to income ratio is shot way down. And then his credit score. Now, normally a credit banking strategy would have a direct effect on the credit score. This had an indirect effect on the credit score because of the credit score is going to be, it's a combination of payment history, utilization, inquiries, all of those things. But the most 30% of his credit score was being kept down by the fact that his utilization was at 80%, right? So now because he brought that utilization all the way down to 0, right, over 2 years, and then if he's using his credit card the right way, following the rules, then he's going to be in a position where his credit score went from 500 to now he's at 680 or 700 over 2 years. Do you think that's doable to go from 500 to 680?
Oh, yeah. In this situation, of course.
Perfect. So here's what he can do. Now that Max, see, he's happy. He was sad before, but now he's happy because his credit is on the right track, and he's started a business. And his business, what's his business do? His business apparently is a real estate business. It invests in his house. That's all it does right now, but it's making money. And so it's helping him save money in taxes, and it's helping him eliminate his expenses. So this business is, I mean, it's a simple thing right now. It's not, people are like, what did Max do? What does his business do? His business invests in his house. That's all the business does right now.
One of the easiest businesses.
So here's what happens. So Max is going to take his excellent personal credit. Well, excellent. He's got good personal credit. He's got a 680 or 700 credit score. He's got low DTI. He's got low utilization. He's going to give a personal guarantee to his business. What's that going to do? Well, his personal guarantee could get the business an additional $150,000 in other corporate lines of credit.
Woo!
And so the business is already at 150. Imagine adding another 300. What if the business, which is in the business of investing in Max's house right now, decides to just pay off the first mortgage, what's left, and then the business owns Max's house, and then Max then has to lease the house from his business to continue to give the business its income. But at the same time, now the business has increased its collateral. The business can go out and get a non-recourse collateral loan against its assets and then get even more money. I mean, this stuff is just, this is great. This is how you create synergy between the business credit strategy and the credit banking strategy, because Max is getting out of debt. He's going to be able to use the business to eliminate the rest of all of his debts. And because those debts look bad on Max personally, on the business side, those debts are going to look great because those are assets.
Oh, yeah.
On the business side, Max is then going to feel freedom, that financial freedom that we talked about. And it was all because he started a business and he utilized the credit banking strategy, and he did this together. Is that cool or is that cool?
That's amazing. He just took what he had and then just that's the whole credit banking process, is just taking what you have and doing it better.
Absolutely.
You already have all the tools needed. It's just moving the money in a different way.
And so I want to show some, like on your screen is like a report from QuickBooks. And this one is just managing the payments, those monthly payments that Max was making if you did it as a loan. Okay, this isn't how you would run it necessarily as the credit side, but you got to keep in mind that you've got to have books. You've got to document everything, right, folks? That's really the amazing strategy that we want to show you. I hope that is probably our most requested video. Would you agree that people have been asking for recently? Is to see credit banking and business credit combined. It is,
because it's such a game changer.
Because when you can get free up cash flow from your budget, and you can utilize lines of credit to eliminate loans and utilize the credit banking strategy, you have the ability to travel across this map and get from where you're at in the land of indebtedness to the promised land, right? The land of financial freedom, using the credit banking strategy with business credit. Now, I have got an awesome case study that we're going to go over here. The case study today is, what if you only had just a couple $100 in cash flow, but you have over $200,000 in debt, and the total time that it would take you to pay off this debt is like 30 years on a mortgage, there's 15 years on a student loan debt, and then you've got like 5 years on 2 auto loans. What if we could work that today and get that all taken care of in less than 10 years?
Well, that'd be exciting to see.
Well, then stick around for the case study, folks. But before we do, Mr. Fleming, I'd like to give you a couple of minutes to go over put this in perspective for folks here.
All right. So each and every week we talk about how this fits into the big picture: business, taxes, credit banking, real estate, education. We call those the 5 pillars because each dollar in the U.S. economy flows through these pillars. So if you don't understand one of these pillars of creating wealth, you won't achieve the wealth that you're looking for. Now, tonight we're going to talk about education. Now, what is education? It's a way that you can gain knowledge, you develop your discipline, you create progress, you create a plan, and you also gain confidence in what you're trying to achieve. Traditional education, average annual earning, this is from 2015 census. High school graduates, $29,000. Some college or associates, $34,000 a year. Bachelor's degree, $50,000, and some type of graduate or professional degree, $67,000. Now, so according to Forbes magazine, the national average cost of attending a 4-year public college is over $112,000, and the average cost of attending a 4-year private college is now over $236,000.
Wow.
That's outrageous. Now, specialized knowledge, that's key. And if you look, now, for example, a lot of, government government professions and things aren't even looking to a college degree anymore to hire on new people. So successful people in all callings never stop acquiring specialized knowledge or skills that are related to a major purpose or business or profession. That's Napoleon Hill, one of the I would say one of the founders of personal development and business development skills. So Renatus is what we talk about a lot, and Renatus improves your outcome. Now, how did Renatus come about? They hired a PhD in education. They learned the instructional system design process that we've already been taught we've already gone through this learning process.
Is that like instructional system design? That's like going on a 100 level class and then progressing to 101, then 102, then
it's a linear way of getting to achieving a goal. Yeah. So Renatus sought out trained investors and industry professionals to become practitioner instructors. Now, what is that? That means it's somebody that does it each and every day. Whatever skill or business that you're learning, you're learning it from somebody that already has that business up and running. It's really if you were to go and want to learn a certain skill or craft, you could become somebody's apprentice.
Yes, I agree.
Where they were
yes.
basically holding your hand along the process until you understood the skills necessary to be able to go out and do it on your own. That is a very similar situation here. Renatus developed and implemented live and online classes. So it's on demand, either live or at your pace. I learn best at nighttime. And so I was able to take those at night. Created the best before and after class support system in the industry. Phenomenal situation that we have with Renatus. So wealth is a mindset. Like Albert Einstein said, education is not the learning of facts, but it's the training of the mind to think. Benjamin Franklin said, if you think education is expensive, try ignorance. I know I've spent, a lot when I could have learned it from somebody else. But go over to followustofreedom.info. This will give you more information on what we do outside of YouTube and outside of this Zoom webinar.
About Renatus.
About the community of business owners, real estate investors that are getting together every single week to go that distance. Because if you're looking to go and achieve your dreams, the best support is to go along with others that are going the same direction. So it's kind of like think about the pioneers, they couldn't survive very well out on their own, but they would go in little packs, in little bunches, and the survival rates were much higher. And so the accountability, just the knowing that somebody else is there to have your back, that's what it's all about. That's why we're here, and we're trying to help you guys go and achieve your dreams, because quite frankly, it keeps us motivated. It helps us stay on the path. We can't give up. And
if they also want to learn more information, they should come Thursday night and see the real estate investing side of what we do.
That is very true. If you have not signed up for that yet, Real Estate Investing Mastermind on Thursday evening, 6 p.m. Pacific Standard Time.
All right. So this is the point of the time where we get into the case study, but this is also the point in time where we say goodbye to our friends on YouTube. Thank you so much for being here. For those who are on YouTube, if you would like to continue on to the case study, all you have to do is go to wiseguysandties.com/events, and you could register and get right into the Zoom webinar. So all of our folks that are here on the Zoom webinar, all 20 of you that are here, just stay where you're at, because we're going into the case study next. But for those who are on YouTube, thank you so much for being here. Like and subscribe if you found any value from what you heard today, because we want to make sure that YouTube knows that this is valuable content that can really change people's lives. That's what we want to do here. And so thank you so much to YouTube. Good night, and God bless you, folks. And the rest of you, stay